Hello and welcome to the Capital Roost. Today we will talk about gas prices. Gas prices are creeping back up, and if you filled your tank this week, you've probably noticed it. Here's why. Renewed tension between the United States and Iran just sent oil prices spiking and energy stocks jumping, while the rest of the market took a hit. If you're in your 40s juggling a mortgage, a commute, maybe a couple of car payments, and a 401k that already had a rough week, this is the story you need to understand right now. Because it's not just about oil rigs and headlines out of the Middle East. It's about what happens to your grocery bill, your summer travel plans, and your retirement account over the next few months. Let's break it down. So here's the setup. Over the past few days, tensions between the U.S. and Iran escalated again, and markets reacted almost instantly. Oil prices jumped, energy names rallied, and at the same time, tech and chip stocks, which had been leading this year's rally, sold off hard, with some of that pressure made worse by weak earnings guidance from a major streaming name spooking growth investors too. That's not a coincidence that these moved in opposite directions. When geopolitical risk rises in a region that controls a huge share of the world's oil supply, traders do two things at once. They pile into energy as a hedge against supply disruption, and they pull money out of higher-risk growth stocks like tech because uncertainty makes investors less willing to pay a premium for future growth. So in the same week, you had energy stocks climbing while the Nasdaq and S&P tech names took a hit. That kind of split market, one sector up, another down on the same headline, is exactly the kind of signal worth understanding because it tells you the market isn't panicking broadly, it's repricing risk in a very specific way. Here's the part a lot of people skip past. Iran sits right next to the Strait of Hormuz, one of the most important oil shipping routes on the planet. A huge percentage of the world's crude oil and a big chunk of the oil the U.S. and its allies rely on passes through that narrow strip of water every single day. So even a hint of military conflict, a blocked tanker, or new sanctions in that region makes oil traders nervous. And nervous traders bid prices up fast, even before anything actually disrupts supply. That's why you'll sometimes see oil jump 5 or 10% on a headline before a single barrel has actually stopped moving. Now let's make this real. Higher oil prices don't just hit you at the gas pump. Although yes, that's the most obvious one, and if you've got a family commute or a long drive to work, that hits your budget almost immediately. But oil is baked into almost everything. The diesel that powers delivery trucks, the plastic in packaging, the jet fuel behind airline ticket prices, even the fertilizer that grows a chunk of your groceries. So when crude oil spikes, it tends to ripple through the economy over the following weeks. A little more at checkout, a little more on your next flight, a little more on your delivery fees, a little more on that summer road trip you were planning. None of these show up as one dramatic hit to your bank account. For a household already stretched by a few years of stubborn inflation, this is exactly the kind of shock that erodes a budget quietly, $5 and $10 at a time, until you look at your monthly spending and wonder where it all went. It's death by 1,000 small increases, not one big one. Here's where it gets interesting for your portfolio. If you're holding a typical diversified 401k or brokerage account, you probably felt two things this week. Your tech-heavy holdings took a dip, while if you own any broad market index fund, energy stocks help cushion some of that blow. This is actually a great real-world example of why diversification matters, and not just as a textbook concept. Energy and tech often move in opposite directions during moments like this because they respond to different triggers. Tech reacts to growth expectations and interest rates. Energy reacts to supply and geopolitical risk. If your entire portfolio was loaded up in tech stocks, this week stung more than it needed to. If you had some exposure to energy, industrials, or simply a total market index fund that automatically holds a bit of everything, so you had a built-in shock absorber working for you without doing anything extra. This isn't a call to go buy oil stocks or try to time this news cycle. That's a losing game for almost everyone. It's a reminder to actually check your 401k allocation this week, not just glance at the balance, and ask whether one sector makes up more of it than you realized. So should you be worried? Here's my honest take. Geopolitical spikes in oil prices happen periodically. We've seen this pattern before with tanker incidents and Middle East flare-ups over the past several years, and history shows most of them are temporary. Prices spike hard on the headline, hold for a few weeks, then cool off once the situation stabilizes, unless there's an actual sustained disruption to supply. That last part is the key distinction. A headline-driven spike is uncomfortable, but usually short-lived. An actual blockade or extended conflict that disrupts shipping is a different story entirely, and that's the scenario that would turn a short-term spike into a longer-term inflation problem that outlasts a few weeks of higher gas prices. For now, the smart move isn't panic, it's preparation. Build a little slack into your monthly budget for gas and travel over the next couple of months, keep half an eye on the headlines without doom-scrolling them, and resist the urge to make any big investment moves based on one volatile week. The people who lose money in moments like this usually aren't the ones who did nothing. They're the ones who panic sold or panic bought on the headline. Rising U.S. Iran tensions pushed oil prices up and rattled markets, and that ripple is likely to show up at the pump and in prices over the coming weeks, even if it doesn't last. Your move right now is simple. Build a little breathing room into your budget, check that your portfolio isn't overloaded in one direction, and keep an eye on this story rather than reacting to every headline. If this kind of breakdown helps you make sense of what's actually moving your money, hit subscribe. Every Thursday, I break down the financial news actually worth your attention. See you in the next one.